Okay, good morning, everyone, and welcome to this morning's edition of the Coffee Microcaps Morning Meeting. You're very welcome. For anybody who is joining us for the first time, welcome. And for many of our regular attendees I know who are joining us, welcome back. I'm just going to quickly run through some intro slides and then we're going to get straight into it with our first presenters. My name is Mark Club and I'm the founder of Coffee Microcaps for anybody who is joining us for the first time. And I'll just quickly zoom through these slides. First off, I'd like to mention DMX Asset Management, who are our sponsor for all our virtual events here, Coffee Microcaps. You are looking for an actively managed small or microcap fund looking at ASX microcaps, please check out their website or indeed make contact there with Stephen or Michael. The compliance and disclaimer slide. Companies we normally have presenting on here for joining us for the first time are generally capped under 300 million in revenue and approaching cash flow break even, or indeed are already profitable. We generally don't have companies from the resources or biotech sector, what I like to call industrial microcaps, which covers everything from healthcare, technology, financial services, FMCG, professional services business, then basically all of those other sectors. Structured this morning's webinar, we've got 2 companies presenting over the next hour. Each company's got a 30-minute slot, which will break down into 20-minute preso and 10 minutes of Q&A. If you do have any questions, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. Please note the webinar is being recorded and it'll be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow us pretty much on all the socials, Twitter, YouTube, as I said, for a recording of this webinar, and indeed all our previous events. We've got probably 100 ASX microcap presentations up there now at this stage. LinkedIn, and I write a free monthly newsletter that you can get on the Substack newsletter platform. Our first presenter this morning, I'm delighted to welcome Riddell and Milsom from Plenti Group, and following that we will have Quantum Intellectual Property. We've got Craig Dower, CEO and MD, joining us for that. So without further ado, I am going to stop sharing my screen and hand over to Ben and Glenn. Let me just stop there. Guys, if you want to...
Thank you.
Thanks
very much. We'll just bring up the presentation. There we go.
Yeah, it's
can you see that
through there now? Yeah, I can see it, so you guys can take it away.
Perfect, great. Thanks very much, Mark, and thank you everyone for joining. We're delighted to introduce Plenti to you this morning. As Mark said, I'm Glenn Riddell, alongside our CEO Daniel Fogo and our Chief Commercial Officer Ben Milsom, who joins me today. I co-founded Plenti in 2014 and now serve as Chief Operating Officer. Regarding agenda, briefly this morning, we'll provide an introduction to Plenti, the large prime lending verticals in which we're taking market share, and the technology that underpins that growth. We'll also provide a brief overview of our full year 23 results, which we announced to market 2 weeks ago. Before we go any further, quick reminder, not personalised financial advice, and I'll also draw your attention to the statements here regarding forward-looking statements. If you're not familiar with Plenti, we're a technology-led lender. In fact, we're Australia's largest fintech consumer lender with a loan portfolio of over $1.8 billion and around 125,000 customers. We have an admittedly lofty ambition. We want to build Australia's best lender, providing fairer, faster loans through smart technology. And supporting this ambition, a few points on the left. One, we're cash impact profitable. As mentioned, we released our full year 23 results a couple of weeks back. We have a March year end in which we announced robust cash impact of $4.5 million. That was up $4 million on FY22. Second, we continue to grow very strongly. In FY23, we demonstrated both strong loan book growth. The loan book was up 36% on PCP, and also strong revenue growth, up 62% to $143 million in revenue for the full year. Number three, we fund prime borrowers, and we have an exceptional 8-year credit track record since we commenced operations in 2014. In FY23, we maintained our track record for delivering really strong credit performance, credit outcomes, which are in fact leading across our listed peers in each of our lending verticals. Number four, we're technology-led. We have a team of about 40 engineers and product team members out of a total of around 200 onshore team members. And importantly, we're founder-led. We have a very long-term perspective on the business. We have very long-term ambitions for the business. I'll pass it to Ben to take you through each of the lending verticals in which we're taking share.
Yeah, absolutely. Thanks, Glenn. And nice to meet you, everybody. So Plenti operates across 3 significant lending verticals, being the automotive lending industry, the renewable energy sector, and the personal loan lending vertical. On the automotive front, we offer secured automotive loans to both prime customers, prime consumers, and commercial borrowers. It's our largest vertical with a loan book of almost $1 billion, $998 million as of March. Our products predominantly distributed via specialist asset and mortgage brokers, though our technology advantage increasingly allows us to play in the dealership and the point of sale, a space where traditional larger lenders are struggling to match the pace of innovation by smaller, more nimble businesses such as ourselves. We offer very competitive rates to those prime customers, but our real key point of difference in the $35 billion automotive lending market is our speed and our ease, which allows applications to be approved in, on average about 1 hour and funded the same day, which is a experience that consumers are increasingly seeking from financial services providers. Over the last couple of years, we've increased our focus on the EV market. We see that as an important part of the automotive industry going forward, but also ties in with our renewable energy lending business. We were very pleased to establish a point of sale partnership with Tesla in the last year, which we've now grown to a significant portion of our business, but also one for which we have deep integration with at the point of sale, allowing consumers to choose a Plenti loan when they purchase a Tesla. On the renewable side, we entered the renewable energy lending market in partnership with the government's Clean Energy Finance Corporation in 2017 to offer point of sale finance to installers for consumers purchasing solar panels, batteries, and increasingly a broader range of energy efficiency equipment. That finance is offered at the point of sale amongst a network of almost 1,000 solar panel vendors and installers. We're increasingly also working with large energy companies such as AGL, Energy Australia, and Amber Electric to help provide finance or other facilities to their customers to purchase solar panels and battery systems. We've built a $201 million portfolio in that space and are continuing to grow our presence both in terms of market share and in terms of the number of installers and vendors we work with. And lastly, we have a significant presence in the personal lending market. We offer a market-leading personal loan offering that offers a better experience and a better deal to credit-worthy customers. We distribute this product predominantly online and also via our network of over 7,000 mortgage and asset finance brokers. These products are predominantly used for consumers to consolidate debt, to renovate their homes, or to purchase vehicles that might not fit traditional lender appetites. This was our original product, and we've grown that loan portfolio to over $568 million in that time. Across each of our 3 core lending verticals, we deploy a strategy which seeks to leverage our technology and help us reach scale and accelerate profitability. And broadly, our strategy can be summed up in kind of 3 areas. The first is we seek to establish market leadership. So we work in large lending verticals and seek to establish significant presence in those markets with differentiated and market-leading offerings. The second thing we seek to do is we continually invest in technology to offer faster, better customer experiences to meet the needs of modern consumers, whilst leveraging our tech to drive operational efficiencies. And last of all, we seek to develop a robust funding platform that provides funding diversity and scalability to our business. An important component of this funding platform is the Plenti Lending Platform, which is an investment scheme that's open to retail investors that allows them to get exposure to our loans. We've now have 22,000 odd retail investors who are registered to lend via that platform, and their investments that they fund can be protected via our unique provision fund model, which provides a loss absorbing buffer in certain circumstances for customers lending via that platform.
As I mentioned at the beginning, we've got a team of around 200 employees onshore with offices in Sydney and Adelaide. We complement that onshore team with a small back office team in Manila that provides loan acquisitions and settlement support, and we have a small engineering team based in Vietnam as well. Regarding executive team and board, we're very fortunate to draw on the experience of highly seasoned banking, finance and risk figures across our business. Notably in this regard, and just pulling a few people off the slide. First, our chair, Mary Plowman, who in addition to recent senior executive roles, notably as co-CEO at Resimac, the mortgage originator, she was a key figure in the development of securitization markets in Australia. Second, our CEO and founder, Daniel Fogo, prior to founding Plenti with Ben and myself. Spent over 10 years in advisory roles at Rothschild in London and Barclays Capital in Sydney. Our CFO, Miles Drury, who immediately prior to joining us in 2020 was CFO of Caltex's retail division, and prior to that spent around 14 years in advisory roles at UBS. And our Chief Risk Officer, Simon Cordell, who joined us in 2016 and who formerly spent around 15 years in American Express and senior roles across Australia and the United Kingdom. He was latterly head of consumer risk for Australia and New Zealand. Allow me to gush a little bit. I'm really proud of this slide. It shows it's not just us that think we deliver outstanding experiences. We think we're the most awarded consumer lender of the past few years, reflecting the outstanding experiences that our customers and partners have with us, the value we offer, and also the growth that we've experienced as a result. And our partners and our customers agree, and we think that's what this slide evidences. We often like to say we've built this business on strong partnerships, whether that's key commercial partners, such as a couple that Ben mentioned, or the likes of AGL, who integrate with us to deliver innovative finance. Other partners include the around 10,000 mortgage and asset finance brokers who are accredited with us to distribute our loan products, or the, as Ben said, around 1,000 renewable energy installers and vendors who are accredited to distribute our renewable energy finance products.
We've delivered very strong loan portfolio growth every year since we funded our first loan in 2014, and we've now lent over $3.5 billion. We've kept this track record intact over the last year, and as Glenn mentioned, we've grown our loan portfolio by 36% compared to FY22. We did this despite increasing borrower rates to reflect the higher funding environment to levels at times well above our competitors, so that we could earn the net interest margins that we wanted to achieve for the business. Pleasingly, our portfolio growth was reasonably consistent across each of our three lending verticals, with our automotive loan portfolio growing 34% in the prior period, our renewable energy lending business growing 42% in the prior period, and our personal loan lending portfolio growing 37% in the prior period. We've been successful also at consistently growing our revenue, reaching $143 million in FY23, and we've been able to translate increased scale into improvements in cash impact profitability, with a cash impact in FY23 of $4.5 million, up from about $0.5 million in the prior year. Note the cash impact that we report is after all of our product and technology development costs, which are about $10.4 million in FY23. Which is a little different to how some of our competitors express that same figure.
Briefly on technology, and just by way of preamble, we don't think all lenders are the same. We think we're highly differentiated in terms of the lending verticals in which we're taking share, our funding platforms, our approach to credit risk and technology, and we think all of those things are reflected in our results today. Just focusing on that last one there. It's our technology foundations that really mean we can do things like deliver superior credit outcomes and over time true economic benefits of scale. We think that's evident both in our track record, in the scale benefits we've already demonstrated, and those that we intend to continue demonstrating in coming periods. Put both Ben and I come from technology backgrounds, and when co-founding Plenti, we had the opportunity to rethink lending from the ground up, to build a platform that achieved our vision of how lending should be. Some of our code is still on the platform, though the engineers of today will tell you it's much less, and they'll be very thankful for that than it was a few years ago. You might have, I often like to say our platform is surprisingly unique in two ways. Number one, we own and build our own technology platform, whereas most of the large incumbents we're taking share from, and surprisingly, even most of our fintech peers rely on third-party vendor solutions. And number two, it's truly end-to-end. So our application, our platform administers the entire credit lifecycle from application, credit analysis via our credit decision engine, all the way through to funding, loan servicing, general ledger reporting, etc. So it's the one platform that does it all. We think ownership and an end-to-end feature set is really important. We think it gives us three things. Number one, rapid innovation. We don't need to wait for a vendor to build things that we and our customers want. We move from idea to feature very, very rapidly. In fact, in recent years, on average, we've released 5 new features or product improvements every single day. Number two, we think that there's strong scale and efficiency benefits in that we can better integrate operations across the credit lifecycle on the one platform. And number three, and really importantly in respect of growth, we can offer superior experiences to our customers and our partners. We can build our version of what we think is a leading borrowing experiences, and we don't have to rely on somebody else's. And when somebody, whether that's a customer or a partner, gives us an idea for something to change, we can do that really rapidly. Finally, for me, briefly on recent credit performance, we've set that out on this slide. As you can see from these charts, we've continued to deliver very strong credit outcomes. Our annualized net loss rate over the year ended March 23, was only 68 bips. Now 90-day arrears at the end of period was only 42 bips. That's less than half of what many of our peers are showing. The question we then get is why is our credit performance market leading? We think the technology platform lets us make smarter credit decisions. Others might say this. We think proofs in the data, and that our credit capabilities really are reflected in our credit outcomes. Looking forward, whilst we think we've taken a prudent approach to credit in recent years, despite a very benign credit environment, we continue to fine-tune our credit appetite and credit policy.
Additionally, through our technology, we've been able to drive significant operating leverage as we scale the business. We're very proud of these metrics. Most notably, we're very pleased with how we've been able to drive down our cost to income ratio over year after year. To give you a sense, in FY21, when we listed the year of the IPO, our cost to income ratio was 55%. In the last year, this has reduced to 34%, making us a very low cost loan originator and producer. In the next year, we expect to be able to show this ratio continuing to improve, noting that it reduced to 37% in the first half and to 31% in the second half of FY23 already. In terms of looking forward, we're feeling very positive about FY24, and you can see by some of the objectives we've set out for ourselves on the left here, which really are first in terms of growth. After keeping loan originations reasonably stable over the last year, we expect to grow loan originations over the coming year, supporting continued loan portfolio growth and helping grow revenue to over $200 million. Secondly, in terms of efficiency, we expect to reduce our cost to income ratio to under 30% and remain on target to deliver $25 million in efficiencies as our cost portfolio scales towards $3 billion. And lastly, in terms of profitability, we're seeking to continue to grow our cash NPAT, though this will be a little bit skewed towards the second half of the financial year. So that's really us and our brief introduction to Plenti and a little bit of an overview of our FY23 results. We're now very happy to hand back to Mark and the attendees for some questions.
Thanks, guys. I might just kick off the first question, and I might just pick up on that last slide, Ben, in terms of, growing originations as we move through the next 12 months. Are you targeting that across all 3 verticals, or is there like one that's going to be a focus for the next year, whether that's automotive or the renewable or the personal, or are you agnostic to, you know, where it's going to come from?
Yeah, look, I think we'd like to see growth across all of our core lending verticals. Obviously, one of the benefits of having a diversified business is that, you know, where there might be pressures or difficulties in one vertical, you can benefit from scale and growth in the others. So that makes us a more resilient business going forward. But, you know, given the environment in front of us, we think we should be able to drive growth and have set, you know, expectations will drive it sort of broadly across the business. Obviously, by dollar value, our automotive loan portfolio is the largest, you know, portfolio that we currently have. So by pure dollar terms, we expect that to show the most contribution to our overall loan portfolio. Even more?
Yeah, the only color I think I'd add there is that so as Ben said, we will place more emphasis on one or the other for growth as circumstances dictate. Most notably, you know, competitive dynamics in each of those segments. You know, where for example we think that pricing it doesn't make as much sense in one vertical, and the return, the NIM that we can earn is not as sensible. We are quite prepared to keep originations a little bit more muted in that vertical for some time. But though it's worth noting, actually, in each vertical having you know, both direct and intermediated distribution does provide a couple of levers there. I think the overall point though is that each of the lending verticals, but notably auto and personal loan, are both very large. Auto is on the order of $35 billion of originations annually in Australia, and we represent, you know, sub 5% of that. So we, you know, would like to keep bringing to bear the experience benefits that we think our platform delivers, the distribution capabilities that we've built up, notably the broker network that we have, to keep taking share.
I see a few questions, but I just want a quick follow on auto, just because I was talking to my brother before we came on air, and he was looking at getting you know, one of these new Toyota RAV4 hybrids, and I mean the guy basically told him 6 to 9 month like waiting list. So I'm just wondering, you know, and that's like across the industry, I hear from everybody, you cannot like get a car. Is that actually restricting like lending growth for you guys, like these COVID supply chain disruptions that it seems to could just be continually lingering within the automotive sector? Is that like hampering your growth, do you think? Or, you know, it's been going on for so long, it's just now, you know, part of the course and it'll eventually resolve itself?
I think it's the latter. I think it's been going on for so long now that it kind of is what it is, and people who put orders in some 6 months ago are now having deliveries, and we're funding those deliveries now. What I will say is, yeah, we have seen those lead times normalize somewhat in the past 6 months or so. So where it was more common to have 6, 12, you know, so in some cases over 12-month lead times for delivery of new vehicles, it's come down. I think perhaps the other thing to note though is that we don't really rely on dealer distribution so much, or at all really. We distribute our auto loans by brokers and the direct channels, so digital affiliates like rate comparison sites and other digital aggregators. And when people are going through those channels, they usually have the car in mind that they're going to buy, and it's usually in stock. And that's where our benefit of speed and efficiency, particularly for the broker in terms of how easily they can apply, how quickly they can get a credit decision, it's where those things become really important. So we haven't been as impacted by long lead times.
I'm going to tackle some of these ones we've got from the audience here. Can you, I'm not sure, Glenn, maybe this is for you. Can you please step through what sort of equity is required as you continue to grow the loan book to the 3 billion target over the long term?
Yeah, I can provide some color there. So just thinking through each of our funding platforms. So Ben stepped through those. We have number one, our retail funding platforms. That's round numbers, 25,000 retail investors who are investing in consumer loans. So no equity contribution from us for that. It's a very capital efficient funding platform in that regard. Number two, bank warehouses. You know, it's obviously reasonably sensitive what our equity contribution to those is, but you know, if you're thinking on the order of 5%, then you're probably not going to be too far wrong. But we already have substantial facilities available there, and we've been able to fund them today because candidly we've raised a reasonable amount of capital today, both prior to listing and at IPO. And then finally, securitization. So at that point, you reduce the equity contribution. We don't want to be too precise about these things, but we're cash impact positive now, and we are very confident we can continue to fund our growth both just by reinvesting those earnings. Yeah.
Okay. Another one then. I think this kind of just goes to the environment we've had over the last 12 or 18 months with rising interest rates. And you talked a bit about it, tweaking the model. Are you knocking back more loan applications in the last 12 or 18 months as the interest curve has obviously massively steepened? And where do where do you see the kind of credit risk trend in the next 12 to 18 months?
Yeah, really, really good question. So, the sort of generic comment would be we're always making changes to our credit policy and processes, reflecting what we're observing, both in respect of applicant populations and changing characteristics of applicant populations when they come through the front door, but also how those then evolve over the credit life cycle. We keep a very, very close eye on that. We've got really strong data capabilities in that respect. With regards to kind of specific changes. Probably the past 6 months or so has seen a period of more changes than probably the sort of 12 to 18 months prior, where there was a more benign environment. And really, if you think about what's driving that, it's more thinking about the change in the applicant population that we're now seeing, and just to give some color there. So now, especially in personal loans, you may be seeing people who are borrowing not for, say, to go on holiday or something, but for reasons where they're just trying to support a lifestyle, and that's candidly the type of credit that we'd prefer not to do. We're unashamedly a very prime lender. We want to be funding customers who could otherwise get a loan from a major bank. How that then all translates through to losses, I think we set out in this presentation today. For the full year last year, our losses were on the order of 68 bips. Though that evolves over time because more recent origination vintages take some time to season and for losses to flow through. Where we think that settles, and we've always been pretty upfront about this, we think that settles at around the 1 or low 1 sort of mark in terms of annualized losses.
And maybe one for Ben, I'm not sure, but Glenn, jump in if you want to as well. Opportunities for market consolidation. Again, I think this feeds back into the rapid rise in interest rates has probably caused dislocations within the industry, which I'm sure you're hearing around the trap. So yeah, opportunities for consolidation maybe in your space, or even an opportunity to maybe move into another vertical through acquiring a provider who's in that space, or the market leader in the let's say, maybe not the market leader for banks or the market leader everywhere, but the emerging market leader, if I can say.
So I'll just give a couple of very quick comments maybe, and then I'll pass it to Ben. So I think having former M&A bankers as CEO and CFO respectively means that there's some discipline around those sort of strategic prospects. I think is the best way to put it. Look, we're not we never close off those opportunities, but we think we're in a position of real strength at the moment, being as we continue to grow very strongly, cash impact profitable, very, very favorable credit losses relative to peers, for example. Look, if I were to sort of cast mind forward, maybe, probably wouldn't be through acquisition, though we keep an eye on particularly loan books as they become available. We think there's a really strong opportunity for partnerships, though. To grow distribution. Maybe Ben wants to.
Yeah, absolutely. I mean, one of the things we didn't touch on this conversation was around how we already are a reasonably partnered organization. I mentioned our Tesla partnership, our Green Connect automotive renewable product is something we have in partnership with a large number of energy companies. That shows we're quite good at working with others to build new products, into new markets, or explore new opportunities. So organic or partnership-driven growth would be much more likely for us. I think more broadly across the market, to your first part of your question, Mark, I think we've already seen some consolidation. I think for companies who aren't able to reach scale and aren't able to kind of leverage those operational efficiencies or build technology that gives them a real point of difference, that will be probably a consequence of those players, their future pathways. But you'll have to watch them more. But no, absolutely, it's an interesting space and one we'll be watching.
Okay. Not the answer I was expecting when you mentioned the M&A backgrounds. I thought to be chomping at the bit in this market, but there you go.
I think they've learned their lesson.
They've been on the other side.
Yeah, that's it.
Ben, thank you very much for joining us. We are just up on time, so I think we leave it there. I know our next presenter is waiting patiently in the wings here for us. So Glenn, Ben, thank you for joining us this morning from Plenti, and if you could please stop sharing your screen, and I will ask, I'm not sure, Craig, are you sharing it? And we're also joined by, I didn't introduce him at the start, Brenton, Lockhart, CFO of QANTM, is joining us as well. So whichever one is going to throw the prezzo up. That's coming through from Craig. Okay, Craig, I'll let you know when it's up. Yeah, I can see the cover slide of your presentation now, Craig. I just want to take yourself off mute as well, Craig. No, we still can't hear you. All right. Let's see if I can. No, I can't do it from my side.
No, I got it. There we go.
Yeah, I can hear your audio now, Craig. So you can, yourself and Brenton can take it away whenever you're ready.
All right, just bear with me 1 second. There we go. All good?
Yep, that looks perfect from my side.
Okay, fantastic. All right, well, great presentation by Glenn and Ben. Hard act to follow, but we'll do our best this morning. So I'm Craig Dower. I'm the CEO of and Managing Director of QANTM Intellectual Property. I'm joined by our CFO, as you said, Brenton Lockhart, who's here this morning. And thank you, Mark, for the opportunity to talk to your team and a number of investors that are on the call. I'm assuming that many of you don't know much about intellectual property, and so we're going to talk a little bit about the sort of industry backdrop, what is IP all about, and then what does it mean for us as a listed company and a group of firms in a broader intellectual property context. We'll talk a little bit about some of our recent results. Our half-year results were in February, so they're a bit tight and dated now. We've got year-end just a few weeks away, feverishly working through all of that, and we bring our results to market towards the end of August, like most companies of our size. So just a bit about the QANTM Group. So we're a very broad group of companies with a diverse set of services across the whole intellectual property portfolio. So really, what does IP mean? It's around helping our clients both develop and then protect their intellectual property. So patents, trademarks, designs. We do work in legal and litigation services as well. And we acquired a business out of New Zealand a couple of years ago called Sortify, which I'll talk about a bit in more detail further on, that has a platform-based approach to trademark application processing and is building a suite of AI-enabled tools for attorneys, which is a bit of a hot topic at present as well. We have effectively 3 brands within the portfolio: Davies, Collis & Cave, which is one of the longest standing intellectual property firms in Australia. DCC also has a law firm, which is set up as a separate entity. FPA Patent Attorneys. FPA, again, is a long-standing business, stands for Freehills Patent Attorneys. So was spawned out of the very large global law firm now known as Herbert Smith Freehills. Used to be Freehills Hollingdale and Page in Australia. And FPA, again, like DCC, play at the sort of top end of the market, large corporate clients, a lot of associate relationships around the globe, and a reputation for high quality and excellence in client service. And then Sortify, which is the newer addition to the family, we acquired almost 2 years ago now, as a bit of a disruptor in the industry and to do some disruption to ourselves in a sense. and really strong team, great capability around AI development, founded by former trademark practitioners within the industry. So it's some deep legal tech expertise, if you like, in their subject matter area. We have just under 400 people spread across a number of locations, many in most cities in Australia. We've also been expanding into Asia over the last several years. We're currently in Singapore, Malaysia, and Hong Kong, and we're looking at furthering that footprint over the next couple of years as well. Our overall strategy and vision, we want to be recognised as the preeminent and most innovative IP services group across the Asia-Pacific region. Asia is a very important part of our strategy, and I'll talk about that a little bit further on. Fundamentally, it comes down to GDP growth and innovation. Where is that taking place? And there's a lot happening across all of Asia: ASEAN, China, India, Japan, Korea, etc. We're going to talk a bit about our pathways to growth. Really, there's three. There's organic growth, and we've been doing a pretty good job of growing market share inch by inch over the last several years. This is a sort of steady, safe, relatively low growth industry, sort of roughly equates to GDP growth. But we have been building market share over the last couple of years, and I'll talk about that a little bit further on. M&A is an important part of our overall strategy as well. We acquired a firm in Malaysia a couple of years ago, 5 years ago now, called Advanced Fidelis, which has recently been integrated into DCC, and then Sortify is the most recent acquisition that we made just sort of 18 months to 20 months ago. And then technology-enabled growth is a really important part of our overall strategic focus as well. So the adjacent capabilities that I've touched on with Sortify, being able to grow our earnings through better automation and productivity, and then tackling a sort of new opportunity in the market, which we've been working on for some time, around platforms and tools with AI at the core of that. We look at, just very quickly, progress over the last sort of 12 to 24 months. We've been a listed company for about 7 years now. We made the fatal mistake 7 or 6.5 years ago of missing our earnings prospectus. We listed at about $2.20, and we did an earnings downgrade and got whacked, and our stock price dropped to about $1.15. And it's been pretty much there ever since, with a decline. We've sort of followed the market over the last 6 to 12 months as well. We think we're undervalued, but we can talk about that a little bit further on. COVID was a disruptor for all of us, but the IP industry was very, very resilient through COVID. In many respects, many of our clients sort of doubled down on R&D. I often talk about the IP industry being really driven by around the global sentiment around R&D. And if you think of what happened to research and development budgets during COVID, or companies that are actively involved in R&D, many sectors sort of doubled down on it. And so COVID has been a reasonably stable period for the industry and for our business. We're a people business at the end of the day. If you look at our cost base, 70 to 80% of what we spend every year is spent on people. And so keeping the team together was a big focus for us during COVID. We've done a pretty good job of that. We did a refresh of our board and executive team over the last couple of years. We've been investing in a sort of generational catch-up in technology. We're making really good progress on that. We've hit a few critical milestones in the past 12 months or so. Sortify I talked about. Market share growth is really happening through a very targeted approach to business development, as well as just continuing to focus on excellence in service delivery. We have very long-standing and sticky client relationships, and I'll talk about that a little bit further on as well. Asia I've touched on. And then with the investments that we've been making, both in people, in M&A and in technology, we had a couple of periods of time, 2 or 3 years, where we had slight decline in margins. We've started to turn that around. We want to see a few more periods behind us to be confident that it's fully in the rearview mirror. Our EBITDA margins at present are sort of in the mid to high 20s, and the guidance we've given investors is our target for that over the medium term is to be in the low 30s. So that's EBITDA margins as a percentage of service charge revenues. I'm going to ask Brenton just to talk to 2 quick slides. One around market share. This is out of a presentation that we did recently at an investor day, and it covers the sort of 9 months actual, so the first 3 quarters of this financial year, FY23. So Brenton, why don't you talk to this, and then I'll bring up the 1-page summary from our FY23 half 1 results as well.
Yeah, thanks, Craig. Good morning, everyone. What we have on this slide is we've got the market share. The first one is in patents for the 9 months, our actuals up until 31st of March. Now, that's the filing, so it only represents about 15% of our total revenue, but it is a good future indicator of pipeline of work that we see coming through. So pleasingly, there's a nice upward trend there. As Craig touched on earlier, we've been making some small gains inside our market share in patents, which has been really pleasing. So for the 9 months of the 31st of March, our market share was up to 16.2% compared to the prior comparable period of 14.6%, which we're really happy about. Asia continues to be one of our big focus areas. Total patent applications for the group is about 16.1%. Our revenue is a lot less than that, but again, because it's the start of a pipeline, and we've only been in Asia probably near on 7, 8 years now, we're really developing the work out that we have there. The next graph is the trademark filings. So you can see we've got Sortify, who in 3.5 years has gone from market entrant to market leader, and they are now the #1 filers in the Australian market. And then DCC, who has been the market leader for a long time, are the #2. So we've got #1 and 2. And you can see that the whole trademark market for those 9 months was significantly down, and 19.8% it was down for the top 10 agents in that period. So even though we've dropped significantly DCC, we haven't dropped as much, so we did increase our market share slightly in a declining market. And on the right, we've got our total trademark applications, which you can see took quite a large jump with the acquisition of Sortify in September 2022. So might go into the next slide. Thanks, Craig. This is a refresher of our half-year results, which we presented to the market when results were released in February. So we can see total revenues up 9.5%, but inside those total revenues include associates charges. So the one we really like to measure is our service charges, which was up 6.8%, which is what we count as our underlying revenue growth. Underlying EBITDA up 7.6% from 13.8%. So as Craig touched on earlier, margins are slowly turning around. We've got that increase of 0.4% from 26.1 up to 26.5. Now we do expect that trend to continue when we put out our full year results. Group patent applications that we talked about before up 6.2%. Trademarks up 11.1%, but that does include the full financial impact of Sortify because they were acquired at the end of September, which helped move that number up. And then NPAT overall up pleasingly 3.8% in the period where we did have a lot higher interest costs. And also we had accelerated amortization on a few intangibles that we had in the first 6 months of the year.
That's great. Thanks, Brenton. I mentioned before that we're a people business, so we always talk about our people when we're talking to investors. We do a lot these days, more than I might have ever imagined, around how to be the place to work for IP professionals. We've done a number of things over the last few years during COVID. We have a 9-day fortnight now with an FPA. We're looking at whether we might roll that out across the whole group. We've got just literally tons and tons of investments that we're making across the board around training and development of our people, around making this an attractive place to work. Our people are the best in the industry, up there with the best. We have multiple awards that we win every year within FPA and DCC. And whilst we're an Australian firm, we're very global in emphasis. Our people are working with associate firms all around the world, in North America, in Japan, in Korea, in Europe, in the UK. And so we have very much a sort of a globalized culture in that sense around our people as well. I sort of talk about the sort of industry, just to give people that don't know much about IP a sense of how this sort of environment works. And so we have very, very long-standing relationships with clients, some that go back 20, 30, 40, 50 years in the case of some sort of big global pharmaceutical firms. And that has a lot to do with the life cycle of the work that we do. And so what we're showing here is really the overall life cycle of both patents and trademarks. Each of them are a little bit different, but broadly they're the same. You have sort of front-end strategic advice, which is often around sort of design and development. You have a filing process that you go through with IP officers in your local location. And this applies to us in every jurisdiction in which we work. We try and build strong client relationships with local firms in every jurisdiction that we're in, helping them with original trademark development and original patent drafting. We think that emphasis around local work allows us to build really deep client relationships. If you're sitting alongside an inventor at the time they're designing and building their invention, and you're helping document that for the purposes of securing IP rights, you tend to build pretty deep relationships through that. And it's also very interesting work for our people. If you're a patent attorney, typically you've got a master's degree, or more often than not a PhD. Your very deep technical expertise around your chosen field of endeavour, and doing that sort of original patent drafting is pretty exciting work to do. And then there's the whole process, as you see, around that, and it goes on and on through a multi-year process, and that local relationship can then spawn, once your patent is filed or your trademark is filed, into filing in multiple jurisdictions, and more often than not, companies that are inventors are always looking to file in multiple jurisdictions, and often in many globally. And so what this slide shows you is, again, going back to the previous one around the overall development of the IP asset, you're then sort of taking that, once it's been sort of filed, and filing it in multiple jurisdictions all around the world. And so what you get is a compounding effect. As Brenton talked before, filings are about 10 to 15% of our revenue, the initial filing in any period of time. But the backdrop of work that carries on after that, over, in many cases, up to 20 or 25 years, means that you've got almost an annuity style of revenue stream coming from clients over time. We have a very broad coverage of diverse technical skills across the group. So within DCC and FPA, we can pretty much cover any industry sector when it comes to having deep technical expertise. And that diversification is a really important part of our growth story overall. Increasingly, we're finding with complex clients that we are doing sort of multi-channel work for them, and bringing together a number of different technical disciplines to be able to help them develop their overall IP asset. We're getting close to the 20-minute mark, right, Mark? So I'll quickly push through the next few slides. I did talk about the importance of Asia. A couple of contexts here, really. First is, in a broad sense, IP growth roughly equates to GDP growth. And if you look at where GDP is growing fastest in the world today, it's in developing nations and in Asia. And so prior to COVID, ASEAN growth rates, GDP were sort of 6, 7, 8, 9%. China's been growing at a very rapid rate for a couple of decades now. Likewise, India as well. And so Asia is a really important part of focus for us. We have historically worked in Asia from Australia, but increasingly having a team on the ground is important as well. And so, as I said before, we're in Singapore, Hong Kong, and Malaysia today, and we're expecting to build out that footprint even further over the next couple of years. This is a slide that just talks about the role that IP plays in innovation. It's lifted from the World Intellectual Property website, and just sort of shows, and we're going through this now when you think about the right-hand side of this. Every generation of technology is ultimately replaced by a new generation, and that new generation tends to create more excitement, more opportunity, more growth than the previous one. And even though industries get disrupted and businesses fail and decline, they're ultimately replaced with something that is growing bigger and faster than what the previous generation was. And at the core of all of that innovation, intellectual property plays a really critical role. This deck will be available on the ASX website and on our website, so I won't go through every slide. What this slide is just intended to show is the importance of research and development to innovation. And if you think about R&D budgets more broadly, just as I said before, in terms of resilience during COVID, what sort of budgets were cut during COVID? Well, travel and expenditure, obviously we couldn't travel anywhere. Marketing spend, advertising spend probably dropped off in many industry sectors. But for companies that were exposed to R&D, that invest in research and development, we really didn't see a decline in R&D budgets at all. In fact, in many industries that were positively exposed to COVID ID, we saw people investing further in R&D. And so that's what this slide is really sort of aimed to show, is the long-term longevity of investing in R&D. Just very quickly, drivers of growth across our three businesses. It's really around our people, leveraging our people, expanding into Asia, continuing to make sure that we deliver excellence in high-quality client service. We're a very high-touch premium firms for DCC and FPA. Sortify is a very different business. Sortify's mission really is to make trademark protection accessible for everyone. Sortify's markets are first-time filers, so companies that are either starting up or have started up but have never filed for a trademark because of the cost and complexity of doing so. And what Sortify has been able to do through their automated trademark platform is take away that complexity and make it cost-effective to do so. So you can go online, you can file in Australia for a trademark application in a guided process, which has a bunch of attorney smarts wrapped in it, for about $600 to $700, depending on how many classes you want to apply for. And then the other thing that Sortify does is building a suite of tools to help attorney productivity using machine learning and AI at its core. So final slide. Again, this mostly came out of our half-year presentation, but just sort of recap on it. We expect to see growth in an organic context continue. We expect to see continued strong market share in Australia, which is our home base, but with further growth in Asia. Investing in our people, our aim is to become the place to work for IP professionals. We think we're doing a pretty good job on that, but you can never rest. It is a competitive market, and we just need to continue to focus on that year after year. We do expect to see continued margin improvement on the back of many of the investments that we've been making, starting to lead through to productivity and opportunities to automate and reduce cost. We had some one-off cash issues in the first half around significant sort of one-off payments and so on, and we expected that to normalise in the second half, which it has done. We've got a bunch of technology investments that we're getting on with, a number of milestones that have been achieved in the past year, and that will continue through FY24 as well. And then just continuing to support Sortify. As Brenton said, they've gone from market entrance to market leadership in Australia in 3.5 years. They're also obviously in New Zealand. They're the number 2 player behind AJ Park in New Zealand, and they're now in Singapore, the UK. They're in Malaysia, and we're looking at another couple of sites being opened. It's a pure SaaS platform, so startup costs are minimal, and we're looking at continuing to support and expand their growth in multiple jurisdictions over the next couple of years. And then, as I said before, M&A is an important part of our overall growth profile, with a very targeted focus around Asia, and we'd be hoping to be able to do something in a couple of Asian jurisdictions in the 12 to 24 months ahead. There we go. So I'll pause there, Mark, and throw it open for questions.
Thanks, Craig. Yeah, just maybe a couple of questions for me just to get the ball rolling. I did want to touch on dividend policy for you guys. It's not too often we have microcaps on here who are actually dividend paying, so we didn't touch on it in the presentation. So maybe just talk about that in the context of the M&A, capital allocation decisions that are going to happen there, and where kind of dividend policy fits into that kind of whole balance between growth versus rewarding shareholders who are already, I guess, on the register.
Yeah, great. So since listing, our dividend policy has been that we pay out in a range of 70 to 90% of NPATA, so NPAT-A, and that's where our historical payments have been. I think the last payment that we made in February was at 80%. A couple before that were sort of closer to 90%. How that goes moving forward, we will see. So, board makes its decision on dividend policy. Well, the policy's been in place for some time. The board makes its decision on where in the range we will make that payment at each step along the way. So each half year we look at where we're going in terms of use of capital, over the sort of 12 to 24 months ahead, and we make decisions around that. But paying dividends has been an important part of our overall investment thesis. So I can't imagine that that's going to change anytime soon. Where it sits in the range might change a little bit from time to time. But we have been focused on paying dividend right from the start. It was part of the overall fundamental thesis in the prospectus when we listed, and continues to be important.
And then just on the margin uplift that you're seeing, I mean, where should one think about if we look at, I'm not sure if there's other IP businesses, listed globally, but, what's kind of normalized margins within the industry for, like let's say a DCC, for example?
Probably in the range of 30 to 40%. That's a pretty broad range, and they can bounce around a little bit depending on how much of the focus is on local versus international filings. Local filings are important for the reasons that I set out before about the depth of the client relationship and the diversity of work that patent attorneys get to do. But they're also complex and messier and require a lot more sort of hands-on work, so the margins can be a bit lower on that, even though the overall sort of dollar amount might be reasonably high because of the amount of work that you're doing. But 30 to 40% would be the range of not just the IP sector, but typical sort of high touch professional services firms are often in that range.
And then maybe one for Brenton, but Craig, jump in if you want to. Debt levels within the business. So you kind of touched on it in the slides that you were going through there about obviously interest rates have come well up. That's going to impact the interest expense line on the P&L. Thoughts on that in terms of maybe getting it down as we move forward, or the use of debt to fund some of these acquisitions versus maybe some equity component. Maybe just kind of where debt sits in the overall mix of the business.
It's a good question, and the answer is obviously it depends which lens you're looking through at that particular point in time. But I think with all our M&A acquisitions, Sortify was an exception. It made sense that we would go and acquire them, but we're looking at accretive acquisitions. That's one of the gates when we look at high quality. So that's what we have. In terms of what we have at the minute, we've got an M&A facility where we have an amortization built into that. So we are retiring some of that, which was around, at the minute, we've got $16.4 million US available to draw down on, which will fund our future acquisitions if we need to draw on that. But one of the things that we had at the half was our debt level increased mainly because our cash position decreased, but we had a $1.8 million fit out that we had in our Melbourne office as we start to do our premises strategy of reducing the footprint that we have. We also had some one-off restructuring payments of 1.2 million, and then there was a prepayment. So our cash conversion went down, was quite low at the half, but it's, as Craig talked about, it's normalised in the second half. So anything extra, we would obviously be looking to either redeploy in investing in the business, but we've got a lot of investments that we're making and we're comfortable in the direction that we're going. So anything extra would obviously be towards retiring debt.
Brenton, might just be worth touching on the cash versus scrip arrangement that we look at around acquisitions as well.
Yeah, so for the acquisitions, historically, it's been about a 70-30 split, 70% cash, 30% script. But that's depending on the deal size. So if you're doing a much bigger deal, generally it could go out to 50-50. But with most people, we're doing that. And the earn-out arrangement's over 3 years. So generally 60% upfront and 40% deferred. So when we do go and make that acquisition, we'll get the full uplift in the EBITDA. But again, we've got the deferred consideration that will help us in our debt and cash position.
Yeah, we want the principles of any businesses that we acquire to be two things, really. Long-term employees of the company, so it's not about buying their business and then sort of sailing off into the sunset, and then shareholders in the business as well. So that split of cash and equity is an important part of the overall M&A strategy.
I mean, you touched on numerous times, Craig, in your presentation, it's obviously a high-touch people business. In terms of actually attracting, staff into the business, how hard is it to get good IP graduates or lawyers, or how attractive when I'm sitting there as a law graduate at Sydney Uni, and I'm like, do I go down the IP route, criminal law, family law, commercial litigation? Where in the attractiveness scale does IP sit in there? I think, if I think of criminal law, you're pretty much locked into Australia, whereas with the IP side, there's a lot more opportunities for international travel for your law graduate coming out today. That might be a bit of a carrot more than some of the other specialisms.
Yeah, where you touch on a few things there that are interesting and true. I mean, IP certainly is a very global industry, and that is true, and that is one of the factors of attraction for us and for the industry as a whole. We're not actually a law firm. We own a law firm, DCC Law, but most of our people are scientists, engineers, chemists, and so they start their career in a technical discipline, and they become patent attorneys. Trademark lawyers will often become lawyers and go through the normal sort of legal training and so on. But the vast majority of our people are actually not lawyers. They become patent attorneys as a sort of second stage in their career after they've worked in industry or in research. And so, that's just a bit of a sort of anomaly around, are we a law firm? We own a law firm, but we're by and large not a law firm. And then really beyond that, hiring people that are relatively young, in their sort of mid to late 20s, and have, as I said, they've been working as a research assistant somewhere in industry, maybe for a university or think tank, and then want to sort of move into the client service delivery side. And so hiring young people and training them is a critical part of what we do. We do that every year. We're bringing on board new people. And our structures are similar to law firms in the sense that we go through that sort of whole process of from trainee to associate to senior associate to principal. And so that kind of apprenticeship model is critical. We are hiring at the associate and senior associate level from time to time, sort of cherry picking new talent in the market as and when it comes available. The market in Australia has been quite disrupted in the last 8 years as a result of the sort of listing of a whole bunch of firms. And so that has meant there's been probably more talent moving around over the last decade than there was in the prior sort of several decades. And we think that creates opportunity for us. And then, as I said, we're constantly looking for, how do we improve our overall employee value proposition? How do we make this the most attractive place to work? And so that's just never ending, right? We're constantly topping up our ideas and policies and strategies around that. Principals tend to be mostly homegrown. 80 to 90% of our very senior people at the principal level have probably grown up within the group. There have been some opportunities over the last couple of years for some lateral hires here and there. But again, we're very selective about that as well, because culture is a critical part of our overall value proposition to our employees as well as to our clients. We want to make sure we get that right most of the time.
Craig, Brenton, I think we'll leave it there. We're just gone over time, and I do want to be respectful of your guys' time and indeed everybody else's. So thanks for joining us this morning. And hopefully we can get you on again maybe after the full year results come out back end of August, early September.
Right, we'd welcome that. Thanks for your time.
Okay, thanks, Craig.
Thanks all.
And thanks everybody for joining us this morning. I wish everybody a good rest of their Thursday.